Welcome to today's market report.
European stocks rose on Tuesday, while Wall Street shares were mixed after another record-setting open on Wall Street as investors shrugged off concerns over Omicron-driven travel disruptions and store closures. Asset classes from oil to equities have clawed back losses from late November when the Omicron variant of COVID-19 sent investors scurrying for safety. A delay in Britain and France on imposing more COVID curbs before year-end also excited investors. As the worst fears over the impact of the variant have subsided, investors have returned to risk assets. The MSCI World Equities Index rose 0.07%, hovering near a record high hit last month, and the Pan-European Stoxx 600 rose 0.6% to end the session at a 5-week high, eyeing its best month since March this year. The S&P 500 edged lower after touching a record intraday high as a 4-day rally lost steam. This is a holiday-shortened week, so daily movements will likely be exaggerated because of a low relative volume. According to CFRA research in New York, the Dow Jones Industry Average rose 0.25%, the S&P 500 lost 0.12%, and the Nasdaq dropped 0.52%. The latest rebound in risky assets was activated last week by new reports confirming that the Omicron variant, although more transmissible, leads to fewer hospitalization and death, according to GFD Group. Japan's Nikkei hit a month's high, and MSCI's broadest index of Asia-Pacific shares outside Japan gained 0.5%. China reported 209 new confirmed coronavirus cases for 27th of December, up from 200 a day earlier, mostly in the northwestern province of Shanxi, where Xi'an, the provincial capital, is in lockdown. In Europe, the British government said England would not get any new COVID-19 restrictions before the end of 2021, while the French government said it would tighten measures, though there will be no curfew for New Year's Eve and schools will reopen as planned in early January. The MSCI World Equities Index is up more than 17% so far this year, and heading into 2022, investors are wary of risks stemming from rising price pressures, slowing corporate earnings growth, and the likelihood of a rate hike cycle in the US. Money growth will slow in 2022, but the market strongly doubts that the ECB and the Fed are willing to truly tighten financial conditions. According to AFS Group in Amsterdam, they now face a trade-off between controlling inflation or keeping this party going. Oil prices extended gains on Tuesday, with Brent crude trading near $80 per barrel, despite the rapid spread of the Omicron coronavirus variant, supported by supply outages and expectations that US inventories fell last week. Brent crude rose 0.66% to $79.12 per barrel. US WTI crude climbed 0.74% to $76.13 per barrel. Gold retreated after hitting a 1-month high on inflation worries, and the spot palladium recovered following a drop of more than 3%. GBPUSD justifies the bearish candlestick formation on the 4-hour chart, while taking offers around 134.30, down 0.1% on the day heading to Tuesday's London Open. The cable pair refreshed the 5-week top the previous day before easing from 134.48. In doing so, the quote portrayed evening dojo style bearish candlestick formation, while also forming the rising wedge pattern near the multi-day top. Considering the bearish MACD signals favoring the downbeat hints from candlestick and chart pattern, GBPUSD is likely to witness further downside. However, a clear break of 134.15 will be clear for the quote's theoretical south run, targeting the yearly low near 131.70. During the fall, the 200 SMA level around 133.25 can act as a buffer. Euro-dollar pressures the 113 level, while Aussie dollar trades around 1.7220, and dollar CAD quotes at 128.16 as commodities eased from fresh highs. Dollar yen trades just below the 115 figure, maintaining its bullish stance. US government bond yields maintained a low profile, holding at the lower end of their weekly range. The yield on the 10-year Treasury note hit 1.455% and currently stands at around 1.47%.
This is today's market news. Thanks for listening. We'll see you next time.